Joining me for more is Scott Phillips from the Motley Fool. Great to see you, Scott. So what happened overnight? Everything ended in red.
Oh, mate, it did. You know what happened? Donald Trump happened. That has been the short version of the headline most of the time over the last month or so. This time around, it was comments about tariffs, no surprise. But the market in the US was dead flat. I mean, it kind of fluctuated up and down a little bit, but it was pretty flat until what about 1:20 their time, 1:30 their time, and all of a sudden, Donald Trump came out and did a few things which, frankly, the market wasn't happy about. All about tariffs. Firstly, saying that the Canadian and Mexican tariffs would start next week. In other words, no deal has yet been done. Now, this, as always with Donald Trump, could simply be a negotiating tactic to amp up pressure on those two countries to get a deal done before it happens. And of course, he also said that he would double the increase in tariffs, not even the total tariffs, the increase in tariffs on China, adding another 10%. That's what he'd already promised to do. Talking about fentanyl importation as the reason. I'm not particularly sure that's anything like the reason, but that's the reason he gave. We know this is a geopolitical tool and a trade tool, not really well, anyway. Basically what that's done is that's pushed the market down 1.6% in the US. Real concerns over US economic growth, real concerns about the impact on inflation. It's a very, very big gambit the president is making. This time around, we'll see how it works. The market is not at all sure it's the right rein to pull, and we'll have to wait and see whether those tariffs do actually start next week.
Okay, and the Nvidia earnings, those also pulled down indexes.
Yeah, and you know what? This is one of those situations where Nvidia has done a spectacular job growing. It's servicing almost the entire AI market with exceptions, and it's done a really good job. It is priced for absolute perfection though right now, Olivia, and maybe it's worth it. Maybe at some point we do look back and go, "Wow, that was cheap back in 2025." But it is absolutely priced for perfection. Good results from Nvidia, probably great results, frankly, but not as good as the market had wanted. And that has been, frankly, with end of earnings season, right? This has been the story for the last 4 weeks, which is when you deliver results, if they are great but not quite as good as the market wanted, your share price falls. If they're ordinary but better than the market thought, your share price rises. That's what we saw with Coles yesterday, by the way. That seems to be the story. Look, AI has got a very, very, very long way to play out. Maybe Nvidia wins. Maybe it powers AI for the next 25 years. Or maybe there are different, options, different outcomes. If another competitor was to enter that market, if prices were to come down, if other solutions or technologies are found, if like DeepSeek was reported to out of China, you can do this stuff with far, far, far fewer chips. Those things really do risk Nvidia's dominance and market leadership. So, look, who knows where it goes from here? I just hope investors are being mindful that there are downsides as well as upside risks here.
And investors really held their breath waiting for those results this week. They're now looking towards PCE figures coming out overnight. What do you see happening there?
Look, I don't do forecasts, as you know. No one knows what's going to happen. We're all guessing as to what might happen. But what we do know is that particularly your US growth, let's talk about tariffs, right? There is very, very strong likelihood that we see increased domestic investment inside the US over time. Why? Because Trump's made it very clear that's the only way some of these international companies are going to do well. Apple is planning to spend $500 billion in the US in exchange for, at least they're trying to trade away that for relief from tariffs out of China. In other words, hey, President Trump, give us a break on the exports out of China. We'll invest some money in the US. Surely quid pro quo, that's enough. In the short term, I suspect there is a bump up for capital expenditure because we see the way that these outcomes should be driven by that policy. Whether there's enough economic activity, whether the cost or the price of inflation, whether there's even enough resources, both human and otherwise, in the US to support that, that's going to be the question in the medium and long term. So no view on the overnight numbers. Long term, it is going to come down to the gamble that Donald Trump is making. Can there be enough growth in the US? Are there enough people, resources, without pushing up prices to deliver what he's looking for and to justify those tariffs? If not, it ends up being a meaningful headwind because that increase in product inflation, final goods inflation, will swamp any benefits they get and will start to actually drag that US economy down and push inflation up.
All right, and coming back home here in Australia, it's been a busy week of reporting season. How have you read some of those reports? Let's start with Coles and Woolworths.
Yeah, we just talked about Coles, and that was one of the. It was fascinating, right? Woolies had the misfortune. Coles had the good fortune that Woolies went first. A 20% reduction in profit on a modest increase in sales shows you how incredibly difficult it is, how small those margins are in retail land, right? In supermarket land in particular. You only have to have a modest increase in costs if you can't make that back with an increase in sales, because of the way the margins work. Operating leverage is wonderful when it goes in the right direction. It's absolutely terrible when it goes the other way. And that's what we saw. Simply Woolies couldn't cover those increased costs with higher sales. And so we saw a 20% reduction in profits. The share price fell meaningfully as a result. Coles did as well. And so when Coles reported the next day and said, hey, our profit's only down by 3-odd%, the market went, oh, thank goodness, and the shares were up. And so that's kind of the market, the environment that they released their results into. As I said, the good fortune of going after Woolies. In both cases, mate, this is, let's be very, very clear. There was no profiteering from the supermarkets. We knew that at the time. I said that at the time. We know that particularly now in these results. If they're profiteering, they're doing an awful job of it because profits are falling. So someone's got to take them to profiteering school or price gouging school if that's what they're actually doing. But the reality is competition's working in that space, right? Neither can get enough sales growth. And by the way, this is a very, very slow growing sector. It can only grow at population and GDP, right? There's only so many baked beans and toilet paper and aren't shapes we all need. And so you got modest sales growth, and that was perfectly fine. But in an inflationary environment, as we've been in the past couple of years, your costs are going to always pressure that top line growth. I don't know whether we're out of the woods yet for Woolies or Coles. Woolies in particular announcing a $400 million cost cutting drive to try and make up some of that. I always ask myself in those situations why they had $400 million with excess costs in the first place, but that's up to them to answer. But there's going to be, I think, a tough 12 or 18 months. If inflation keeps coming down, if cost inflation in particular keeps coming down, that's going to be very, very good for their business. That'll help them use that modest top line growth to deliver some bottom line growth. But that's the challenge of these sort of retailers. If you're a low margin retailer without pricing pressure in a concentrated market where there are no easy market share gains to be had, that's the sort of issue you're going to have to come up against.
All right, and Qantas, the share price did quite well yesterday, and we saw their results coming out, and there was some record passenger numbers, particularly for Jetstar. They mentioned 1 in 3 people travelling for less than $100, really kind of doing what they can in the cost of living crisis. How did you read the outlook for Qantas?
That's certainly the spin they wanted us to swallow. They also talked about the net promoter score being up. And it's interesting, when the airlines were so universally, I won't say despised, disliked, let's put it that way. It wouldn't take much for that simply to go away. Sometimes all you need to do is have an easy act to follow, and that was the case. The Qantas brand had been largely trashed over the previous 3 or 4 years. So the recovery of that wasn't a surprise. The good news for Qantas shareholders is profit was up meaningfully, $936 million, I think it was. A really nice jump up in profit, up about 6%, declaring a $400 million dividend. You speak about outlook. That $400 million was made up of 2 parts, a $250 million ordinary dividend and $150 million in a special dividend. Now, what the company is saying very clearly is that special one is a one-off. In other words, this is, if not the best of times, certainly about as good as it's going to get. I think maybe things get a little bit better for a while, but the tide is all the way in for the domestic airlines in particular. And we saw domestic airfare actually increase, the average price increase over time. No surprise, they'd put Rex to the sword in Metro, both Qantas and Virgin, and have absolutely been dining out on the spoils ever since. So we saw a really good domestic operation. International ticket prices down 6.6%, though, interestingly enough. So that's going to be an ongoing challenge for Qantas to try and manage. While ever Virgin and Qantas act in rational self-interest, even without any collusion or cartel behaviour, as long as neither of them add capacity, they can pretty much set their prices for tickets. And we know in that circumstance, an increase in ticket prices is far more valuable to them than increasing capacity. If and when one of them blinks and decides to add capacity and chase market share, then all bets are off and we're back down to chasing volume, and that means lower prices. So as a traveller, you want to hope they add some capacity. As a shareholder, you want to hope they retain that rational self-interest and say, well, if I don't do it and you don't do it, we're all going to be okay. That seems to be the way that both airlines are travelling right now, and without any competition from anyone else, including Rex, that had to go home with its tail between its legs and is now fighting for life. That's the situation we find ourselves in. So a really good number for Qantas, but as I said, because the tide is all the way in, I'm not saying it can't get better, but every bit of input, every circumstance is in Qantas's favour right now.
All right, and let's touch on WiseTech. We had earnings on Wednesday and a bit of a shake-up on the board there.
Yeah, shake-up is putting it mildly, Olivia. We saw 4 independent directors resign, citing intractable differences with the former CEO and now, again, executive chairman, Richard White. This has been a boardroom tussle for a while now. White had agreed to step down, had agreed to take on a 10-year consulting agreement, but had never quite signed that agreement. And obviously behind the scenes, unseen to us, was a power play. Richard White controls a large amount of shares. Most of the commentary we're seeing from most analysts and most funds is Richard White is more valuable inside the business than outside the business. It seems like in the background there was enough votes in that to basically push out those independent directors and for Richard White to be appointed executive chairman. Now, whether you like or don't like what was done personally or professionally at WiseTech and in Richard White's private life, the reality is we're now seeing a situation where ASIC this morning has quoted Joe Longo, that the chair is saying we will be looking at WiseTech. Hasn't launched a formal investigation and is certainly not prejudging any outcomes, and we're not doing that either. But it is remarkable to think that that's kind of where we've got to. ASIC just making sure everything's been done correctly. ASIC saying, hey, look, you guys really should have some independent directors again. The question really is, will those independent directors, if appointed, be given sufficient reign and sufficient autonomy and authority on a board where Richard White is absolutely, casting his vote widely and make sure he gets what he wants. And again, remember, most investors, it seems, are saying, well, that's not such a bad thing. Richard White built this business. He grew this business. He's the power at the company. We want him inside the tent rather than outside the tent. The challenge for the company, I think, particularly, is to understand those professional issues and allegations that may have been raised. And again, I make no allegations. I certainly make no suggestion of guilt or otherwise, but that's going to be the key one for the company. And again, if ASIC was to launch an investigation and was to potentially find some of the directors or management weren't suitable, and in fact, at the very extreme, ban them from holding those positions, then investors have to ask what does come next. So plenty of choppy water for WiseTech. It's a great business, done a wonderful job, has been an incredible wealth creator for a whole lot of people for a long time, doing a great job in the space of a freight forwarding software where it's concentrated its efforts. So a really, really difficult one. Lots of moves on the chessboard yet to come, but certainly going to be in focus, I think, for weeks to come.